Well, hello. I'm so glad you joined me. I'm Kevin Attride. I'm your financial coach to high net worth families, and I'm just so glad you joined us for this live episode of Ask Me Anything. Before we get started, I really just wanted to help you to understand a little bit about me. I have a rich history in finance all the way from when I was little, saving money, investing money, spending money. And so I help high net worth individuals, and I'll tell you about a client story coming up. But first and foremost, I want you to grab a pen and a sheet of paper or a notebook. I want you to write down some important tips that I want for you this evening. And before I dive into some of those comments, I want to make sure that you're asking me questions. So I'll stay tuned to the comment section. Make sure you're asking me questions because I want to answer your questions on the fly in real time. So whether it's a easy question, whether it's a complex question, I'll try to answer all of those as well. So send me your questions. Let's take a look. So let's get into a little bit of content before everyone writes all their questions in, and maybe you need a little time to think about it. First, get your notebook and your pen or your pencil. I want you to write down these 4 words: give, invest, pay, spend. Give, invest, pay, spend. That is the framework that I often teach my clients around how they manage their money and how they're able to be successful with their money or of greater success, and how to be impactful with their money. So first and foremost is give. And you may say, why in the world is give first? Give is about impact. And I know a lot of individuals who have high net worths, but yet they're not happy individuals. They have everything that you would think you would ever want you to be happy, but yet they're not actually that happy. And I would argue it's primarily because they have low impact in the lives of others. They enjoy their money, but yet when they buy that new vacation house, go on that new vacation, whatever it may be, it's not good enough. And so give is the aspect that solves for that problem. And so whether you're a high net worth individual, 10, 50, $100 million, or whether you're someone who says, I only have $500 in my bank account, give is the primary element to ensure that you're leveraging impact in your life to make sure that you really feel wealthy, that you really feel the impact of wealth as you impact others' lives. And so give is something that you do routinely. It's not just saying, I have money, a little money left over, but it's something that ahead of time or right now, you're determining what organizations, whether that be a charity, a philanthropic organization working in another country, whatever, or maybe it's a single mom somewhere and she needs help, or maybe there's that down and out family, the husband lost his job. Whatever it may be, I want you thinking about, and if you're a praying individual, I'm a praying individual, I want you to consider thinking about, praying about, what is the impact that I want for my life? And it can be really big, hairy, audacious goals. It could be really simple, like helping your neighbor when he's on downtime. So give is the first aspect. Give, and next is invest. So I want you investing in yourself. And investing in yourself is perhaps one of the best things you can do, more than investing in other organizations. First, invest in yourself. And put your money to investments. And someone may say, well, I thought you're supposed to save money first. Saving money can be a wise aspect, but investing money is something that you will do, and that's how you create that wealth generation vehicle. And when you think about investing, you think about, how am I putting this money to best use? I was talking to a sophisticated individual the other day, and they had no clue how to invest any of their money. So a very smart individual, but no concept. And so I would argue, whether you want to invest in your 401k, your IRA, your 403b, whatever vehicle that you might use in the stock market, whether you're investing in real estate, whether you're investing to ensure that you have the right emergency fund, because the last time I checked, I saw people losing jobs and industries failing. The banking industry is one of them, and we're going to talk about that in a little bit. But there's an element of protecting yourself. So it's, first, I want you to invest in yourself, invest in your education. That's what you're doing right now. And invest to create the biggest return on your investment at the lowest risk. And we can talk later around how you adjust for inflation and taxes and so forth, maybe risk as well. But you want to invest in yourself. And savings can be part of it. That's the larger scheme. And maybe there's a question on that later. But give, invest, pay. Next, you pay your bills. So I'm telling you to make sure that you're putting money away towards your investments, towards maybe short-term savings. You want to do that before you paying your bills, paying your mortgage, paying your taxes. And you may say, well, what if I don't have enough money left? It's a consideration of how you are spending your money, or the framework for how you manage your money. I would much rather you invest in yourself and have the right investment vehicles that are going to further you for the long term, excuse me, even if you have to go to one of your creditors, whether maybe that's you have student loans, or maybe that's your TV bill. I would much rather you call them up and say, I'm actually short of funds. Can I pay you next month? Can I delay? Whatever that may be. But I want you to invest in yourself before you pay your bills. And it's a really good opportunity for you to say, maybe I can get rid of some of these that I don't actually need. I talk to so many individuals, they have like $200 of streaming services every single month, and they're not even really using half of it. And I would argue most of it is junk. So pay your bills next. Give, invest, pay, spend. After you've paid your bills, after you've given, you've made an impact in the life of others, and maybe in an organization that is impacting others. After you've invested in yourself and your family and your friends, and you're maximizing your ROI. After you're paying your bills, that's when you spend your money. That's when you go on the vacation, that you buy that new piece of clothing, or whatever it may be. Maybe it's the latest gadget. Maybe it's that latest iPhone or Android phone. That's when you spend your money, after those things. And so often people are doing these in the reverse. I hear people, they're spending their money, and then they're trying to pay their bills, and then they try to save, and they have very little money to invest in themselves, or in others, their family members, or really to prepare for the future, or to even build that wealth vehicle. And then they're just not even giving, period. And so there's no impact, very little impact in their own lives. So you want to spend last. And that's hard. I don't pretend that this is easy, but this is the framework that I'm leveraging for my high net worth clients on how they manage their money wisely and set themselves up for not just success this month or this year or next year, but how they're setting themselves up for their lifetime and for generations. And you think about, you want to give your kids, or maybe it's your grandkids, great things. You think about, you need to manage your money wisely so that you're able to impact the lives of others, your kids, your grandkids, maybe it's a friend, and definitely yourself. Give, invest, pay, spend. Okay, next, and we'll hold on some of these questions. I wanted to talk about mindset, and the framework of give, invest, pay, spend is a mindset, but I want to just briefly talk about mindset. So often I encounter clients and other individuals that they're just unsure of themselves. They lack confidence. They're not sure about what to do. I have a dear friend who worries all the time about everything. And you may be saying, well, I don't know a lot about this, or I don't know a lot about that. I want you to develop the mindset of success, the positivity that says, I can and I will be successful. I am going to work and develop the right habits that enable me to develop the right characteristics that leads to success, that leads to impact, that I can look back and say, I've done really well for myself and I do well for others. It's a mindset that allows you to set goals and to achieve them. And I've often talked about SMART goals. You can use that, maybe use other, but you just need to have goals. And I want you to take a moment now with your pen and paper. I want you to write down just 2 goals. Think about 2 goals for your life that you want for you and or your family. 2 goals, financial goals specifically, on investing or otherwise. Maybe it's saying, you know what, I'm going to try to practice that give, invest, pay, spend. Maybe it's I'm just going to try cutting a few of the expenses that I know are not good for me or I don't even use. Maybe it's a habit, whether you're gambling money or you're on spending sprees. Maybe it's an addiction. Whatever it may be, I want you to write a couple goals down that will allow you to be more successful in the future. I also want you to think about the mindset of growth, of being a lifelong learner. And I'll tell you, my most successful clients, they are naturally lifelong learners. When I talk about a specific book or a presenter, a speaker, they naturally are interested in learning more, hearing that individual and taking away the best elements to apply to their lives. It's a growth mindset. And I often encounter people that fail to have the growth mindset. They lack positivity and they're just about getting by. But I want you to think about how you're going to develop that growth mindset to say, you know what? I like learning. And you need to pick the field or the interests that you really like. And especially around investments, some people love stocks. Other people love real estate. Maybe someone likes tax liens, or someone likes private notes, or someone likes Forex. Whatever it may be, I want you thinking about something that you want to learn more about, that you're already curious, or maybe you know just enough about it and you want to dive deeper. So develop that growth mindset. And okay, lastly, but around mindset, I want you thinking about how you develop a wealth creation engine. You heard me right, a wealth creation engine. If I were to come along and hand you $100 million, in 5 years, would you be able to turn that into $1 billion? Or let me make it a little easier. If I came along and handed you $100 million, could you turn that into a 200 million? Maybe you say that's still too hard, but I want you to consider, if I came along and gave you $100 million, what is your wealth creation engine to maximize those dollars? Or am I going to come along and say, you don't have a wealth creation engine. You don't even have the processes by which you understand how to maximize your returns and minimize your risk. So I'm going to go to someone else and hand them the $100 million. I want you to consider, and let's be more practical, because very few individuals have $100 million to invest. So let's just say I gave you $1,000. How could you turn that into $2,000 in in 5 years. So I just want you to contemplate that and take that away as some homework. I want you to have a wealth mindset on how to maximize your wealth creation engine. Okay, I want to tell you about a success story. So one of my clients, I'm going to call him Jimmy. Jimmy has 7 figures of capital to invest, but he had it spread across a few different banks. He was far above the FDIC limits, and he was looking for, how do I maximize this interest rate and how do I minimize my risk? 7 figures. So I talked to him about the infinite banking concept. And clearly, it took a little bit of time for him to grasp the concept. But when he understood it, he was so grateful. He said, you know what? I can see a future of 10 to 20 years that using my money wisely with this concept, the infinite banking concept, I can turn this 7 figures potentially into 8 figures. And he had the right mindset, a wealth creation engine mindset. And paired with the infinite banking concept, he could maximize and see a future of which he could turn 7 figures into potentially 8 figures. And we live during a time of great instability of our commercial banks. And I don't think the average person really realizes how precarious we are. And a little bit more on this in a minute. But one of the things that this infinite banking allowed Jimmy to do was to take his money out of the commercial banking process and put it into a life insurance policy. Yeah, you heard me correctly. A life insurance policy that allowed him to create a contractual agreement for growth. A contractual agreement to grow his money. And at a higher rate than the commercial banks were giving. And I'm going to have an upcoming webinar to talk all about the infinite banking concept and how it's so powerful and how there are numerous wealthy individuals using this, but it's the concept that they don't really want the average person understanding. And it's really impactful because life insurance, the life insurance industry is highly regulated. And so there's great security in the life insurance contract and in the industry. Whereas so many of the commercial banks collapsed during the Great Depression in the 30s. Life insurance companies sailed right through. And so I'm going to be doing an upcoming webinar to talk about that. But it leads me to talk about banking insecurity. And I just have a few thoughts as this is a hot topic right now. You want to make sure if you're using a regional bank, then you want to ensure that that bank has a great rating. And I'm not talking about going to Weiss or Moody's. You want to go to the Weiss rating agency and take a look at your bank. And I'll leave a comment below on the Weiss ratings. But you want to make sure that your regional bank is poised to do well, as many of the regional banks are entering hardship. As interest rates continue to go up, they have the potential for greater insecurity. And so you may say, well, let me just run to one of the big banks: Chase, Bank of America, Wells Fargo, Citibank, Goldman Sachs, Morgan Stanley. There's about 5-6 banks that have tremendous capital and money sitting in their accounts, or I should say on their books rather. They're the big banks, but these big banks are giving you pennies on the hundreds of dollars in interest rate, or they're giving you nothing. Maybe they're charging you money to hold your money. And so I don't often advocate, and my wife and I have moved away from using the big banks. And we still keep a relationship, but I don't want to hold a lot of money because they don't give me funds that are necessary. And so when you look at inflation as it used to be measured, inflation is anywhere between that 12, 14, maybe 15%. And so it's far higher, potentially double what they're telling us. And so you think about earning nothing on your interest rate on a big bank, and that's just terrible. And so I want you to think about some alternatives. I want you to research the infinite banking concept and think about that for the future. Take that down as some homework. But also, you think about there are online banks and regional banks that may give you better interest rates, 3, 4, 5, maybe even 6%, depending on when you're listening to this. So consider that. And you may need to move your money around, but you want to make sure that you're keeping up a good relationship and adhering to their policies and their limits. Okay, that's banking insecurity. I do predict there will be numerous banks in the future to collapse, whether we see that in a few months or in the next year or two. Okay, and so there's some comments coming in. Write your comments. I just want to briefly highlight investments. So as you're thinking about return, I want to just highlight you can think about stocks. Stocks can be quite volatile, but maybe you've done a lot of research and understand. I'd be careful of investing in the indexes if it's in a shorter time horizon, and maybe even as a longer time horizon. There's a potential we're still in a bubble, and you could invest money and the stock market loses 20%. So you just want to do some due diligence, talk with your advisor and say, where are we in the market? And you want to do some analysis. What's your return to risk? So you want to maximize your risk-adjusted return, but you also want to talk to your financial advisor. You want to talk about what is your inflation-adjusted return. You heard me correctly, your inflation-adjusted return. And they're going to tell you the CPI. You can go to Shadow Stats, and I'll provide that a link later. You want to go to Shadow Stats. They have the inflation as it used to be measured. And I told you it's about double. So let's just argue it's 12%. And your financial advisor says, well, with this index, we're earning about 14%. After inflation, you're only getting 2% on your money. That's not very much. So think about that. And I also want you to think about your tax adjusted return. So often people aren't even considering that. And so think about money, whether you're doing pre-tax, whether you're doing Roth, you want to ensure that you're maximizing your tax adjusted return. And so that leads me to real estate. And real estate is one of my favorite investments. And I was just talking with a client about real estate, and I have a tool I want to send you in just a moment. But in real estate allows you to not only cash flow monthly, and real estate often can be very passive, but it puts your money into your bank account monthly. That's the cash on cash return, but it also enables you to maximize your money because of taxes. There's a lot of tax incentives on real estate, but also because of the appreciation that is like an inflation hedge, but also the amortization of your loan. And so when you take out a loan, let's say right now you're able to get a loan at 6%, but if inflation is really at 12%, then over the long term, you're actually gaining dollars. And that's a really good thing. And then you have your renters, or whether it's self-storage, whatever it may be, paying down your loan, building equity. And so there's a lot of really good things about real estate. And let me put in the comments, I just want to put this tool. I'm putting this in the comments, deal check. And I've sent you the link that allows you to get 20 or 30% off on Deal Check, and you can use some of the tool for free, but the paid tool is relatively inexpensive. And so, especially if you're looking into real estate, I would advise you go purchase the tool and use their algorithms, their formulas to help you to maximize your return. And there's even that promo code best deal. So use that link. Use the promo code best deal. Deal Check is an amazing app to analyze a property or many properties and help you to understand, is it actually a good deal? Lastly, I want to just talk about investments during today, and I get a lot of questions about gold. Physical gold is something that you definitely need to think about, especially if you're holding reserves, your emergency fund. You don't want just a lot of cash sitting idly by. And physical gold is one of the best aspects to help you to keep the value of that asset over generations. So, and we can talk a little bit more about that, but this isn't a gold ETF. This is physical gold. And whether you hold it privately, whether you're holding it in an IRA, physical gold is a great investment, especially when you need capital for your reserves or your emergency fund, or maybe it's simply because you plan to deploy some capital at some future time, but you're worried about the inflation risk or the banking risk right now. Okay, let's talk. Some comments, some questions coming in. Okay. Hot stock tips. You know what? I'm someone that I don't generally tell people go out and invest in this. And I like to say Jim Cramer is one of the epitome of doing this. He says, you need to go buy this stock, buy it right now. Well, you know, he told people to go invest in certain banks, SVB, Silicon Valley Bank, days before it collapsed. And so what might be hot for one person is clearly not the best for someone else. And so I don't generally invest in hot stock tips. What I will tell you to do is do your due diligence. So Warren Buffett is looking at stocks all the time, and he's saying what is great value that he can hold over a long term. He's not just a flash in the fire, flash in the pan, invest in this, and then get out. So that's what I would suggest. You generally want to be in investments over the long term. And I know a lot of investors, and I like to recommend this as well, playing the contrarian view. So many people are saying, buy this stock, buy this, and people get in, and then the rug gets pulled out. So they bought high, and then things fall, and sometimes the people get afraid and they sell low. I want you thinking about when can you sell high and then get back in when it's low. And I actually have a good friend who does this. She's like, I put a bunch of money in when there's a stock crash, and then when I feel that it's risen a good amount, before I feel that it's a bubble or too high, that's when I pull out and I make a good amount of money. And so there are a number of tax implications for that, dependent. And maybe you have a Roth 401k, 403b, IRA. That's good to do because you want to make sure you don't have tax implications on that. Or maybe it's just a pre-tax. But want to make sure that you're doing that in a tax-advantaged account. Banking. First Republic. Should I get my money out of First Republic? Yes. Yes. Get your money out of First Republic Bank. I don't care what the experts are saying is how they're going to stabilize that. Get your money out of First Republic Bank. All right. You mentioned gold. What about Trump coin? Trump coin. You know what? I have a great a great friend who is my own precious metals broker. He's an amazing individual, man of high integrity. I have a great relationship. He develops wonderful relationships with his clients to be over the long term, not just transactional. And I'll put a link to him later on. He likes to say, you know what? Be careful when they are marketing these new coins, whether it's that brand new double eagle or the Trump coin, or maybe it's a Biden coin. You want to make sure to stay away of those new specially minted coins, because they're going to have a hefty profit because they're selling it as unique, when really it's just a newly minted gold coin. And so if you need gold coins for, or maybe it's silver coins for your IRA, just go with the standard stuff. You want to make sure that you're minimizing the premium over the spot price. And I would suggest don't buy the Trump coin or any other specialty coins. Okay. Another question here. Real estate. You mentioned real estate. What about real estate in Florida? Florida is a good state, a very good state, especially when it comes to landlords and dependent on the county property taxes. You want to make sure that you're not buying real estate in a bubble. And so there are certain markets you want to be careful of. What I would say is Florida generally is very positive, and there are a number of other states. You want to make sure that the property is cash flowing. Don't just plan on appreciation. You need to ensure that at least cash flows somewhat, and that's how you need to structure the deal. That's why I recommend Deal Check to look at all of the various aspects. But Florida is a really good market. You want to make sure that there's strong job growth and population growth. And the more population growth, often that creates a stronger market, because it's creating great demand on housing. And so rental rates go up, especially when there's huge job growth. That means people are going to be flocking. So that's a number of things to think about. Florida, generally very positive, great landlord friendly. Okay. Florida, yes. Okay, and another comment. Well, what are some other good markets? I like the Southeast, maybe the Southwest. I like landlord-friendly states, because it's a matter of time, especially if you're in multifamily, if you're in single family. You're going to have the tenant who doesn't want to pay. I recently had a tenant who didn't want to pay. And so when you're in states that are landlord friendly, it's easier to get them out. You don't want to be in a state like New York, maybe New York City or California, especially select cities in California. It can be so hard to get that tenant out. Hey, you mentioned 401ks and stocks. What about matching? Yes. I'm a big proponent. If an organization, if you're an employee and they're doing a match, you want to invest to maximize your match. And even if you're saying, I really like real estate, I want to put more money in real estate, my suggestion is, unless you've closely analyzed your real estate portfolio and it is blowing the doors off your stock investing, your employer 401k, because of inflation, taxes, risk adjustment, then unless it's blowing off the doors, I would suggest you want to match. That's the free money that the organization's giving you. Now, clearly, you have to take into factor the volatility of the market. What's the return? Recently, we've had some bad years, but generally positive on the match. Okay. Cryptocurrency. What do you say about cryptocurrency and Bitcoin? Cryptocurrency, I would argue it's something to take with caution. 20 years ago, cryptocurrency didn't even exist. 3 years ago, there are cryptocurrencies that don't exist today. And so if you're going to invest in a Bitcoin is probably the most solid, stable cryptocurrency. And if you want to dabble, experiment, or maybe you've done a lot of research and you found a niche on how to invest, just know that there's a lot of elements that, like the stock market can be volatile, cryptocurrency can be of high volatility. And I guess I need to speak a little bit about CBDCs, central bank digital currency. My belief at the present time with the research I've seen is I think our government and the governments across the world, all the central banks want to create this digital currency. And we see a number of countries bringing them online as we speak and dabbling with them. We're going to see this put pressure and we're going to see people flocking to cryptocurrency. But I'm concerned that the government is actually going to highly regulate or attempt to regulate or to control. And so does that mean it could shoot up in value? Possibly. Maybe there's some economic levers that get pulled that with the control and potentially the passing of new legislation that we could see people fleeing from it, and it could happen very fast. So I approach cryptocurrency with caution. I'm not saying you should not invest in it, but caution. Yeah, I'm gonna leave it. I'm gonna leave it for there. Okay, another comment. You mentioned real estate. What about vacation houses? Vacation houses, yeah, great. They can be a great investment. You know, the question is, do you want to spend a lot of time there? Maybe it's a second house you're using as a vacation house. There are a number of tax strategies you can use to, when you have a business, to leverage this vacation property, the second home, for tax purposes. Maybe you just want to own it as investment property and you're there every now and then. You want to make sure that it's in the right market. So vacation, you generally want it to be somewhere where lots of people like to go. Just know that there are certain times in 2020, travel took a huge hit. So you want to be ensure that you have good reserves and you have a backup strategy in case tourism or travel or all the vacations in that market fall away. And you want to make sure that it's cash flowing. More questions about gold. Two things. What type of gold should I buy? And isn't gold a little expensive? Gold is expensive because the dollar is worth less and less. They are printing trillions of dollars. And you think about when you hear about Zimbabwe or Germany pre-World War II, they'd have wheelbarrowfuls of the currency. We are headed during a time when we're seeing inflation rampant and things like groceries, the price just keeps going up and up and it's going to get worse. And so you're saying, is gold not expensive? It's not that gold is getting more expensive. It's the dollar buys less and less of it. And so that's why I suggest now is a great time to buy gold. And what type of gold? So if you're buying an IRA, you're going to buy the kind that you can put in your IRA, minted by the US government, maybe the Canadian government, American Eagles, Maple Leafs, and your precious metals dealer. And if you want a suggestion, I told you I'm going to put that in the comments later on. He will guide you, especially my friend who's just an amazing individual who is an expert. He's an expert in helping people with liquid asset portfolios. And he does an amazing job of rebalancing portfolios and ensuring that you have the right balance and the framework. And he's even told clients this is not a good time to buy. So he's a man of integrity. I'll put his name and contact details in the comments below at the end of the session. But the type of it is a good time to buy. And if you want gold in an IRA, it's going to be your official gold. But if you want to hold it privately, and I believe there's going to be a gold confiscation in the near future. So you want to be able to hold it privately. Uh, and that's dealing with semi-numismatics. And just for sake of time, we won't go into the details, but you want to talk to your gold dealer and my gold dealer, he is an expert in semi-numismatics, so he helps individuals buy the right gold because you want to make sure you're not paying a hefty premium, but you want something that's going to remain private and be far less likely to be confiscated. Okay. How do I maximize my rate at my commercial bank? I see they're offering CD, certificates of deposit, CDs, or a friend of mine refers to them as certificates of destruction. I would say unless you can pull your money out of the CD without penalty, you should not be putting your money in a CD. CDs can be one of the worst strategies to use because here's a good example. You put your money into a 2-year CD and they're offering you 5%. What happens when the interest rates continue to go up? 3 months later, you can get a savings account for 6%. A year later, they're at 7%. And so you're kicking yourself that you put the money into this CD. So interest rates change, and I don't see interest rates coming down anytime soon. I think with inflation the way it is, interest rates are likely to go up. So CDs lock you in, and I think they lock you in to destruction in the near future. Okay. Okay, so where do you actually maximize your rate? So I mentioned there's some online banks, and they seem to always be changing. That's kind of the problem. There's about 10 different online banks that usually are offering the highest rate, but they fluctuate. They're not almost always the same. And so do you open accounts in 3 or 5 of them and you're constantly moving your money? Possibly. But that's why the infinite banking strategy is so helpful, because the infinite banking strategy, you have a life insurance contract that guarantees a certain amount that is often beating what commercial banks are providing. But there's the ability to earn even more based on the dividends, which is a return of premium, which is tax-free. Unlike the interest that when you have your money in and let's say you're earning 5%, let's say you get back $500, you have to pay taxes on that $500. Whereas the $500 you would earn in the infinite banking bank, that $500 is tax-free. So if you're interested, stay tuned. In a couple weeks, we're going to have a webinar on that. And also you can visit my channel, Investing Secrets with Kevin Attride on YouTube, or you're already here. And I have a number of videos on infinite banking. Okay. Okay. If inflation is so high, how do you beat inflation? What do you do? Certain stocks might, probably a little hard. I think real estate, it might be a little challenging, especially when you want to use debt. I'm a proponent of using debt in a smart way, in a conservative way when you're buying an asset like real estate. And so you want a really good mortgage broker who can help you to make sure that you're getting the best rate for your investment property. Or if you're an accredited individual, like most of my clients, they can go with a firm. Wellings Capital is a great organization you should check out. They have an inflation, I'll call it an inflation resistant, economic challenged, risk adjusted portfolio. Recession resistant is probably the best way to describe it. Portfolio, so that when the economy tanks, that's when you see some of their best returns, and they have a lot of really good returns around real estate having to do with mobile home parks and self-storage, but they're also into some multifamily, some light industrial, etc. Real estate, I would say, is one of the best. Looks like we've already covered a number of that someone saying they didn't catch the very beginning, that framework for managing money. Give, invest, pay, spend. And you want to go back to the beginning of the video and watch it again as I walk through. But give, invest, pay, spend. That is what you want to focus on, how you manage your money. All right, I believe that's most of all the comments that we have today. And if I didn't get to you, write your comment, and then my team and I will take a look, and we can get back with you. But just really appreciate your time with me, and I just wanted to highlight one thing. I want you to think about this practically. So many people get they freeze because they're not quite sure about what to do. I have one client who's just taking the bull by the horns, boiling it down to something practical, and saying, what, I can move forward on this. And I say, that's great. You just want to be an action taker. Measure twice, cut once, but you want to be an action taker. And so think about something that's really practical that you can do over the next 30 days using my framework. Give, invest, pay, spend. Focus on that. And maybe you have in a few different areas. Over the next 30 days, I want you to focus on something practical so that you can experience financial freedom.